All right, time to jump into some research about machine learning and the business cycle. You sent over some interesting stuff. It's a blog post from Quantpedia. This post summarizes a recent academic paper, and it's something we can all relate to, right? Economic ups and downs. But this is from a machine learning perspective. Like, who knew algorithms could have trouble with recessions?
Well, yeah, it is a really interesting challenge, and it kind of gets to the core of how these machine learning models handle, those unpredictable events. You see, most financial models are trained on periods that are relatively stable, especially the ones using machine learning.
Makes sense. Markets are generally pretty predictable, at least in the short term. But then, bam, recession hits and everything just goes crazy.
Exactly. And the paper actually makes this comparison to the Dunning-Kruger effect.
Oh, interesting.
Yeah, that cognitive bias where people overestimate their competence, like in areas that they don't really know much about.
Yeah.
It's like, in a bull market, everyone's a genius when things are going up. But
Yeah.
then, a downturn comes along and suddenly those predictions, not looking so smart.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So are these machine learning models just not that smart? I mean, are they falling victim to like their own version of the Dunning-Kruger effect?
It's not about, smarts. It's more about the data that they're trained on. What the researchers found was that the main issue is volatility.
Okay.
Recessions are notoriously volatile, right? The market is swinging up and down. And that really throws off the algorithms. They just aren't equipped to deal with that level of uncertainty because, they were trained on data from those calmer times.
It's like trying to use a weather app that's made for like sunny California to predict a hurricane in Florida. The tool isn't necessarily bad. It's just, wrong tool for the job.
That's a great analogy, yeah. And the paper goes on to explain, what happens when these models are faced with this kind of data shift. And they tend to underperform, significantly during recessions. And that's a huge problem if you're relying on those models to make investment decisions.
So what did the researchers try to do to get around this? Did they just feed the models more data, hoping they'd figure it out?
They did. Yeah, they tried all sorts of things like adding in historical data about past recessions, factoring in risk-free rates, even including like macroeconomic factors. But the results were really mixed. Some things helped a little, others didn't do anything, and then some even made things worse during recessions.
That's so interesting. So even with more information, it wasn't an easy fix. Why is that so surprising? And what does that, I guess, tell us about the challenges of using machine learning, for this kind of prediction?
I think it really highlights how complex these economic systems are, and how interconnected they are. Recessions aren't just about a few variables going haywire. They're really about, a whole web of factors interacting. And you can't really predict those ways. They're unpredictable. It's a challenge even for, human experts, let alone algorithms.
It really makes you realize that machine learning isn't, a magic solution. It's powerful, but it definitely has limitations, especially when you're dealing with something as complex as the economy.
For sure. But the researchers didn't just stop there. They came up with a clever way to use these limitations to our advantage. They came up with a method for detecting recessions early on using the models themselves.
Now we're talking. Tell me more about that.
They did it by adding something called a decoder to the prediction model. Think of it like as a double check system. And this decoder, what it does is it tries to reconstruct the inputs that were fed into the model in the first place. So it's basically saying, hey, does this data look familiar based on what I've learned about normal market conditions?
So it's like the decoder's like a seasoned investor, like, scratching their chin and saying, these market signals seem a bit off.
Exactly. And that's where it gets interesting. Because if the decoder struggles to reconstruct those inputs accurately, it's like a red flag. That deviation, that reconstruction error, it becomes an early warning signal for a potential recession.
Interesting. Okay. I'm starting to see how this could be useful. But before we get into how it works, let's step back for a second. Can you explain some of the key inputs the researchers used for their models?
Sure. They started with some of the basics, things like stock prices, interest rates, and economic indicators.
Yeah, makes sense.
But then they also included some, less obvious factors like the FAMA French 3 factors. They're basically additional metrics that can help capture different aspects of risk and return in the stock market.
Okay.
So one factor is size, which looks at performance difference between small companies and large companies. Another is value, which compares companies with high book-to-market ratios to those with low ratios. So essentially how much a company's assets are worth compared to its market value. And a third factor is momentum, which just observes, the tendency for rising stock prices to continue to rise.
So by adding in these factors, the researchers are, giving the model a more, like a well-rounded picture of the market, not just relying on those simple price movements.
Exactly. And remember, the goal is to detect a recession, which is a complex event that doesn't always just show up in simple stock price trends. These additional factors can pick up on those more subtle shifts that might be pointing towards a downturn.
Gotcha, that makes sense. So we've got these models trained on all these different factors, and we've got this decoder that's, searching for anything unusual. What happened next? I mean, did this actually work? Could it actually tell the difference between, normal times and those recession warning signs?
The results were pretty promising. They tested it out on several decades of U.S. stock market data, which included 7 different recessions.
All right, so a pretty decent data set.
Yeah.
And what did they find?
The interesting thing was that they saw this noticeable spike in the decoder's reconstruction error, right around when each recession started. Like the decoder was saying, hold on, this market behavior doesn't fit with what I know about a healthy economy.
Right.
Something's not right.
So it's not just about the stock prices dropping. It's about those, underlying factors behaving strangely. Like maybe that size premium is getting smaller, or value stocks are doing better than growth stocks.
Exactly. The decoder picks up on those subtle changes in the market, not just the overall direction of prices. And the really interesting thing is this spike in reconstruction error, it often happened before the official recession declaration.
Oh, wow.
By groups like the National Bureau of Economic Research.
So we're talking about like a lead time here. That could be really helpful for investors or businesses, trying to make decisions during those uncertain times. I mean, even just a few weeks or months could make a big difference.
Absolutely. It would give them a chance to change their strategies, get ready for the tough times, maybe even find some opportunities in the middle of all the chaos.
You mentioned earlier that the researchers also tried adding in a bunch of other data, historical recession data and macroeconomic variables. What was the thinking there? Did it actually help?
They basically wanted to see if giving the models even more information about the economy would improve how they performed during those recessions. They thought, well, if we give it more context, maybe it can better anticipate those volatile times.
Right.
But the results, they were kind of all over the place.
Not as straightforward as the decoder.
No, unfortunately. I mean, sometimes those additions seemed to help a little bit with some models, but the improvements weren't consistent. And you know what? Sometimes adding more data actually made the performance worse during recessions.
Really? That's counterintuitive. I would think more data is always better. Why do you think that happened?
It's kind of a case of too much information. In machine learning, it's not just about how much data you have, it's about the quality of that data and how relevant it is. If you start adding in variables that aren't actually useful for prediction, it just creates noise, especially with something as complex as a recession.
So it's like trying to bake a cake, but the recipe includes like a handful of gravel. It's going to mess things up.
Exactly. It's about finding the right balance, Give the model enough info to learn, but don't overwhelm it with irrelevant stuff. And it looks like, for recessions, that decoder approach was much better because it focuses on how well the model understands the market, not predicting specific events.
That's really interesting. It seems like it's important to really understand those limitations of machine learning and figure out strategies that work with those limitations, not try to force the models to do something they're not good at.
Yeah, for sure. You have to remember machine learning is a tool. And like any tool, it has its strengths and weaknesses. And that decoder approach is a good example of using those weaknesses to our advantage.
Okay, so we've talked about a lot here. We saw how those traditional machine learning models can struggle with recessions because of that market volatility. And we learned about this cool decoder approach that uses those struggles to make an early warning system. It's a really neat solution, but I want to understand like how it actually works. Can you walk us through like the mechanics of this decoder? How do you train it? And how does it spot those weird signals?
So let's break it down. The decoder itself is actually a type of neural network. It's called a multi-layer perceptron, or MLP. And these MLPs, they're really good at finding patterns.
Right.
But the key here is that it's trained specifically on data from periods without a recession.
So it's learning, like what normal looks like in the market based on all that data, prices, factors, economic indicators, but only from those economically stable times.
Exactly. It's like, showing the decoder a bunch of pictures of healthy trees, right? And saying, this is what a healthy tree looks like. And then when you show it a picture of a tree that's, diseased or maybe damaged, it can tell something's wrong, even if it's never seen that specific damage before.
That's a great analogy. So the decoder is basically making a baseline of what a healthy economy should look like based on those patterns it's seen.
That's it. And when new data comes in, say, the current market conditions, the decoder tries to reconstruct those inputs based on what it's learned about that normal market behavior.
Okay.
If it can reconstruct the data pretty well, that means things are looking normal, consistent with a healthy economy.
Makes sense.
But if it has trouble reconstructing the data, that means something's off. There's a mismatch between what it expects and what's actually happening.
And that mismatch, that reconstruction error, is what triggers the alarm bells, the warning sign for a potential recession.
That's right. It's like the decoder is saying, hang on a second, these signals, they don't fit with what I understand about a healthy economy. Something weird is going on.
So smart. It's like using the model's own limitations, the fact that it can't perfectly predict recessions, and turning that into a source of insight.
Yeah. It's not about forcing the model to make those predictions directly. It's about using its understanding of normal behavior to find deviations from that norm. And the research suggests this approach can really work for providing those early warnings.
This is a cool example of how machine learning can help us navigate this unpredictable world.
For sure.
It's like we're talking about a whole new way to solve problems. Instead of reacting to crises, we're using machine learning to anticipate them and, take action before things get out of hand.
Yeah, that's the idea. This research is really just the start. As we get more data and develop more sophisticated algorithms, the potential here is huge.
This deep dive has been so eye-opening.
It's been a great conversation.
And as always, knowledge is powerful when we put it into practice. So, our listeners, take these insights, experiment with them, and who knows what amazing things you might discover. Thanks for joining us. And until next time, keep those brains buzzing.